Hi everyone, my name is Vendik and you're welcome to the channel. Okay, on price action series, we will be treating institutional candle today. Okay, so don't forget to do the YouTube business as we journey on. All right, let's get to the chart so that we'll explain this. Okay, when we are talking about institutional candle, it mustn't be a candle. All right, this is what you have to put in mind. Okay, that institutional candle, it mustn't be a candle. Okay, let's take for instance, we have a kind of a consulting area, something like this. Okay, let's take for example, we have something like this. Okay, where market bounce off of, okay, rejects multiple times. Okay, multiple times, and let's say the overall trend of the market is down. Okay, then the situation, you will see something like this. You see something like this, a kind of a candle breaking above those highs, and then later comes back. Okay, did something like this. Okay, this kind of situation, all right, if you check, the market just kind of bounce off here, bounce off here, bounce off here, bounce off here. Okay, it mustn't be like 4 or 5, it can be 2, it can be double top. All right, and then you see a sudden candle will break above those support level, and then it tends to reverse back to the range and start falling. Okay, so the whole of this move, okay, is considered as institutional candle, right? It can be a candle, it can be a move. All right, why I said it can be a move is because if you go to a lower time frame, if it is a candle in 1 hour, if you go to 5 minutes, it's not going to be a candle, it's going to be a sort of a collective candle moving in one direction. So institutional candle, it can be a move. It's not necessary for it to be a candle. Okay, so let's take for instance, I think I make some drawing that will really help. Okay, let's take this for example. All right, so let's say market bounce off of here, like bounce off of here, market bounce off of here, bounce off of here. Okay, bounce off of this point. Okay, that's 2. Before it bounced twice like this, retail traders tend to get into the market at this point. Okay, let's say get into the market for a sale at this point because the market is coming back. Maybe put their stop loss above, okay, the previous swing high or something. They just find a liquidity that they can put their stop loss off of. Okay, so what this is what institutions do. All right, when they come, all right, they first of all buy the market above the initial entering position. Okay, they buy it above initial entering position, and then the market will tend to wipe every other person's stop loss, right, before the market sells off, before their position is triggered. And then where they always sell off, okay, it's always at the round figure. There will be no fractions in those numbers. This is another thing you need to put into consideration. Okay, if they are buying at 1 okay, 30, okay, if it is, this is where they are buying, okay, they won't buy at 1.30879. No, 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 they will buy it at something that is round figure. Okay, something like this. They will buy it at something that is round figure. Okay, something like 1.30800. Okay, there will be no fractions in those numbers, so they tend to buy it uh, at a whole number. Okay, so you always need to be looking at this so that you know where your entry is going to be. So if we want to reverse this, so if market was bouncing off all these levels and then you kind of have a push up, it doesn't mean market has reversed. Okay, depending on the area you are and the trend of the market. So it doesn't mean it can just be an institution coming in to take over the market. So you really need to be aware of this each time you are in a trade. And then probably if your stop loss, if you are someone like me that always keep 30 to 40 pip stop loss, okay, to give a trade a room, all right, it kind of give me more confidence, okay, why I'm trading, okay, than just doing all these 7 pips and 10 pips SL. Okay, so it's something like that. So it all depends on you, but this is this is the definition of institutional candle. So when you are doing a price action trading, you should be expecting something like this. Okay, a whole lot of persons give you the name like a fake out, liquidity sweep, all right, liquidity like the okay manipulation. Okay, there are a whole lot of name, a whole lot of persons are giving it, but it tends to just be the way markets react. Okay, all right. So because one thing, if you know the basics of trading, is that if you want to buy things in bulk, you need to go and see where sellers are. Okay. So a bearish move, okay. For an uptrend, you first of all see a bearish move, okay, below the previous support level. First of all, see a bearish move below previous support, and then this will tend to happen around a round figure. So you need to study this more by yourself, all right, and then be able to enter the market off of that. Okay, this will really help you. Okay, so in price action, you will always see something like this. When it has to do with price action trading, you will see a whole lot of manipulation in the market, and this is they call it manipulation. So I just see it as persons coming in with bulk of money, looking for more liquidity to grab so that they can sell off the market. So everybody needs to be smart, all right, so that at the end of the day they will be able to go home with something. So it is that's just it. So you really need to put this into consideration and then redefine every of your entry. Let it be that you are grabbing from a liquidity, okay, okay, so that you can join the trend. So I believe this really explain institutional candle for you, because you will hear the name and it will look so funny and it might cause a confusion in your head. So this is just what it is. So if you want to check it per, okay, let's check example on a real chart. Okay, so let's pick up something that can really works out. Okay, this is typical example of it. I think that one did previous one didn't really define it because there was a whole lot of wick on it. So this is it. Okay, okay, let's take this as an example. All right, market bounce of this place. Okay, I think we have first, second, and third here. Okay, so this particular move, if you check it very well, all right, if you check it very well, it tends to reverse around a whole number. All right, tend to reverse around a whole number or the fraction. So these are things you really need to put in place. Market is already, it's selling, it's going to sell. Okay, but all the people that enter, because after this first pullback, okay, a whole lot of persons are going to place their sell order here. Okay, a whole lot of persons are going to place their sell order here with a stop loss a little bit, maybe above here or something. Okay, they target the next previous high. Okay, this was the previous move, so they will target it, okay, as their next support. Okay, maybe the market didn't get to there, another set of person entered the same thing, and they were expecting the market to sell off of this zone, because if you didn't see this play out, you will not know. Okay, this was a very nice bearish move. This was a very nice bearish move. This was a very nice bearish move with a correction into a fair value gap, very clean. Okay, so we are expecting a sell off of it, which the market finally did. But do you look at this place? Just look at this particular point. There is a whole lot of manipulation around here. Okay, after this first rejection, maybe you get into this candle, you, even if you calculate it, the pips of this will be very much, look at, almost 300. So no one keeps their pips up to that level. Okay, but you see the manipulation that happens here. Let me remove this and zoom it so that you see. So you see a whole lot of manipulation happening here. Okay, market breaks off of this. Okay, if you calculate this move, is it's a more of almost 155 points move. Okay, that move alone, if you were all these breakout traders, okay, you feel okay, market has changed direction, you now enter for a buy. Okay, that's not it. Okay, the overall trend of the market was bearish. So this kind of breakout might just be an institution that comes into the market. Okay, so if people that were doing breakout after the first impulsive move, they'll get in for a buy, and then the market reversing, it hits their stop loss, and the people that were putting a sell on this particular place, their stop loss too will still be hit. Okay, so they have advantage on how they manipulate the market. So I believe this alone should be able to explain institutional candles. So you have to be conscious, put this into consideration before entering to any trade. Okay, so if you find value in this video, don't forget to do the YouTube business. Just share it so that every other persons can get the information.